During the Industrial Revolution, you could argue that every nation on Earth was developing into an industrialized society. Some nations emerged faster than others. The term emerging markets was coined by Antoine van Agtmael in 1981 while he was working for the Institutional Finance Corporation, IFC, a division of the World Bank. He hoped to create what he named a set of promising stock markets, lifted from obscurity, thereby attracting the investment they needed to thrive. Currently, some notable emerging market economies include India, Mexico, Russia, Pakistan, Saudi Arabia, China, and Brazil. Critically, an emerging market economy is transitioning from a low-income, less developed, often pre-industrial economy towards a modern, industrial economy with a higher standard of living. Some notable developed market economies include most of Western Europe, Australia, Canada, Hong Kong, Japan, New Zealand, Singapore, and the United States. Characteristics of developed markets may include strong economic growth, high per capita income, liquid equity and debt markets, accessibility by foreign investors, and a dependable regulatory system you can trust. Why would you want to take the risk of investing your money in emerging market economies? Investors seek out emerging markets for the prospect of higher returns, because these markets often experience faster economic growth as measured by gross domestic product. However, along with high returns usually comes much greater risk. The risks include political instability, domestic infrastructure problems, currency volatility, inflation, foreign exchanges, and illiquid equity. Some emerging economies do not have the regulatory institutions as the developed economies do. Hence, it can be a challenge for them to implement new laws or provide better opportunities to local investors who can help with the development of the market by introducing new businesses. Emerging markets typically have a physical financial infrastructure, including banks, a stock exchange, and a unified currency. A key aspect of emerging market economies is that, over time, they adopt reforms and institutions like those of modern developed countries. This promotes economic growth. Emerging market economies tend to move away from activities focused on agriculture and resource extraction toward industrial and manufacturing activities. Their governments usually pursue deliberate industrial and trade strategies to encourage economic growth and industrialization. These strategies include export-led growth and import, substituting industrialization. The former strategy is more typical of economies that are considered emerging, since it promotes more engagement and trade with the global economy. To understand the emerging markets better, let's visit some of the countries which are marking their spot on the economic landscape of the world. Take Brazil, for instance. The country has been a significant driver of growth in Latin America as the largest economy. The country is involved in recovering from the worst recession in its history. This recovery has resulted in a 1.1 increase in GDP growth. The inflation rate has been reduced to 2.13%. Investors interested in betting on a rebound in Brazil have a wide range of options, ranging from exchange-traded funds to several large companies like oil producer Petrobras, which has a New York Stock Exchange-listed ADR. India's economic growth rate is close to that of China, 6.7% to 6.9% in 2017, respectively. Investors in India have also seen some upside, positive returns, over the past several years. The BSE Sensex India Index is a measure of continuously performing stocks has come close to doubling since 2016, indicating good growth and confidence by investors. India's large English-speaking population and technology-savvy firms such as Infosys Technologies have been molding India into an emerging market. With a population of 1.4 billion, China is the world's most populous nation. India is a close second with 1.3 billion. In comparison, USA's population, 332 million people. China's economy has been slowing down over the past couple of years, but it remains a major global growth driver. Charlie Munger, vice chairman of the conglomerate Berkshire Hathaway and longtime business partner of Warren Buffett, praised China's poverty elimination success, automation, and economic advancement. Nobody else has ever taken a big country out of poverty so fast and so long. And what I see in China now just staggers me, Munger said. China has managed to lift about 100 million impoverished people out of extreme poverty since 2012. The country has thus far eradicated extreme poverty, achieving the poverty eradication target set by the UN 2030 Agenda for Sustainable Development 10 years in advance. Now imagine, all of those 100 million people needing new cars, new smartphones, flat-screen TVs, and computers. The same may happen to India next. By 2030, the complexion of the global economy could look very different than it does today if more of the emerging countries manage to lift a larger number of their populations out of poverty. By the year 2030, countries like Egypt, China, India, Indonesia, Turkey, and Brazil will all see their economies expand with triple-digit growth in GDP terms. This is where the biggest growth potential lies. In particular, India's economy will see rapid population growth in its cities, which are some of the fastest-growing urban areas on the planet. At the same time, Egypt's economy is expected to grow from $1.2 trillion to $8.2 trillion, according to the bank. Although we would add that this seems quite optimistic. Finally, developed economies like the United States, Germany, and Japan will keep growing, but just not at the blistering pace of developing countries. Adding some emerging markets funds to your investment portfolio is probably a risk worth taking. The world is processing much faster today than before, with the global economy more connected than ever. What do you think? Please comment below. This has been today's episode. I hope you all had a great time. Thanks for joining. Make sure you subscribe to the channel, hit the like button,